This is a Momentum Media production.
The SMSF Advisor Show. Your expert insights into the biggest themes shaping the SMSF advice industry.
Hi everyone and welcome to the SMSF Advisor Show. I'm Miranda Brownlee and I'm joined by my co-host Aaron Dunn. Hi Aaron, how are you?
Very well, Miranda. Yourself?
I'm good. Lots happening again in the last week or so.
Oh, wow. Hasn't that put the cat amongst the pigeons? So, yeah, we'll get onto it in a second, Miranda, and what's making news. So I'm going to hand straight over to you.
Yes. So obviously the biggest talking point in the last 2 weeks has been this announcement about the $3 million threshold, which will impose that extra 15% tax for anyone with earnings for that amount above the $3 million. And we've obviously had a bit more detail released on that in the last week or so on how that calculation will work, which has been controversial in itself, I would say.
Yeah, so isn't it funny, we saw this legislated objective of super, of which they really wanted to bed that down before sort of looking to move at the budget. And then how many days was it thereafter? Not many. We saw the Prime Minister and Treasurer stand out and make the announcement. And then within 24 hours, we saw a fairly comprehensive fact sheet. So quite clearly, this had been floating around for some time. I did question some accuracy in some of the fact sheet, but that's a separate issue that I think we'll talk about at another time. But yeah, it has certainly been very controversial in its application. And most importantly, the controversy relates to the fact as to how the calculation will work. Simply looking at opening and closing total superannuation balances, which, as we know, will factor in a whole range of things that are not accessible to an individual. So like unrealized capital gains or unrealized gains and losses are included in that calculation, and therefore will have individuals imposing tax on them without actually having realized particular assets. And it gets worse because not only do you have to pay tax in years where your balance has gone up, you only get a credit in the years where they may have gone down. So you could end up in a situation whereby you've paid a lot of tax, it may adjust back, you may wind up the fund, and of course those credits then get lost forever as well. So yeah, I'd like to hope there's a lot more water to go under the bridge on this particular topic because it has more holes in it than Swiss cheese, I'd say.
Yes. And then the last few days, he sort of hinted that they're intending to just keep with that calculation, but hopefully they are open to maybe tweaking that. Obviously, there's been a lot of analysis done by yourself and people like Meg Heffron as well, which have sort of raised all those cash flow issues and the sort of issues of fairness, which you spoke about before. And there's also not a lot of detail at this point about how a reversionary pension or insurance proceeds is going to be treated either.
Yeah, so you've only got to look at something like a reversionary pension whereby they're looking to penalise people above 3 mil. Well, all of a sudden, if you have a husband and wife situation, and naturally it's a similar sort of feel to the way in which that individual has a lifetime currently $1.7 million cap. And Anthony, our guest, will be talking about that more shortly. But these sorts of things where all of a sudden a client will tip themselves over the $3 million balance because of a pension reverting or whatever is going to change the entire strategy landscape with death benefit planning too, and maybe capturing people that the government wasn't really thinking about was going to be in that initial 80,000 either. So there's a bit of a class warfare going on when you read about it. So the tone is these people need to pay their share. On the flip side, saying, well, actually, I don't think the reality is people aren't thinking about not paying their fair share, but you've actually got to have a fair system because there's not many other pieces of legislation, if any, that actually tax people on unrealized assets within or that are held generally, either themselves personally, superannuation or otherwise. So, hence I think the consultation that will then happen will be quite critical. And therefore, I suspect there'll be a fair amount of lobbying that would happen that goes beside what Labor is trying to do. So, yes, to say the least, it's been a pretty busy week on that front.
Yes. So aside from that pretty major announcement, we also did see quite an interesting court case come out of the Supreme Court of Victoria, which was to do with a lost trust deed and whether binding death benefit nominations were actually valid or not. So this was quite an interesting case, as the court had to sort of rely on pieces of evidence, but they were actually able to establish that trust deed that did validly establish the SMSF.
Yeah, so it's this case of Alisal in the Victorian Supreme Court, as you said, Miranda, and I guess it covered two things, I think, from memory. First was around this implication of the missing trust deed and the question of fact as to whether, if you have a deed that has been lost, can you, in essence, replace it with something else, and therefore will it stand up in a court of law? And naturally, on the basis that if that document then is valid, do the documents that are created off the back of that, are they also valid as well? And as you touched on then, Miranda, that was talked about in the context of binding death benefit nominations. So it is a pretty important decision in the Supreme Court that really goes through the various years in which there was, I guess, the establishing deed and the fact that that had been missed. And then there was deeds that had happened thereafter. I believe they found some deeds and therefore, there was a conclusion ultimately come out off the back of, the specific facts of the case. But it does provide some pretty interesting guidance here that allow us to understand whether that lost trust deed or not may actually assist people in certain circumstances.
Yeah, and we did also see ASIC ban another SMSF properties broker. Seems like this still comes up every so often where there's an unlicensed individual trying to roll money over into SMSFs to establish a property. Obviously, in this case, they weren't an actual advisor and they were giving unlicensed advice to people.
Yeah, and again, this just shows that ASIC, I guess, are still out in the marketplace actively looking at these sort of arrangements. There are also circumstances where we're seeing these cases go up to AFCA and decisions being made there. So by and large, you'd like to hope that these issues have been resolved, but in many respects, as we saw in the Council of Financial Regulators report linked to the use of LRBAs and leveraging super, there are still some pockets of concern, and these types of examples, I guess, are a reflection of that. So we hope ASIC continue to work actively in this space and apply the full force of the law where they deem it to be appropriate.
Yes, and we also saw the ATO issue a bit of a warning around people who want to use, I guess, undated benefit payment requests where they, I guess, fill out the whole request form but leave it undated, and then at the last moment, if there's like an impending death, they, sign and date it. They've warned that they would have some issues with that and have just advised people against it, I guess.
So, Miranda, do you know what this is called? This is called the weekend at Bernie's principle. So you got to make sure that we don't end up with situations where we're getting the arm and we're actually trying to sign this stuff where the individual's already dead. But in all seriousness, I think the ATO, through their updated guidance on their website, has really put the cat amongst the pigeons in respect to what their expectation is in the context of an SMSF versus potentially in APRA-regulated funds and the knowledge that the trustee has around some of these scenarios. And I think as well, we saw at the SMSF National Conference, Eminent Rosenwig made comment, I believe, as well, just about the fact that a lot of the private binding rulings have also had some commentary updated into them as well, just to make them aware that they are specific to sets of circumstances and therefore making sure that the circumstances that are specific to the case at hand will be what is tested rather than simply relying on what may have been thought of and read in the past as well. So, from that point of view, leaving documents undated pose some pretty significant risk, and therefore you want to be making sure procedurally you're following what the trust deed says in respect to, what is a valid commutation and making sure those documents are lined up and the execution of what needs to happen happens shortly thereafter as well.
Yeah. So that's probably the biggest things that have been happening in the last 2 weeks. But shortly, we're going to be speaking to Anthony Cullen from SuperConcepts, who's going to be taking us through some of the strategies and key considerations now that we know that indexation is going to occur with the general transfer balance cap from later this year. So we're now joined by Anthony Cullen, Senior SMSF Technical Specialist from SuperConcepts. Hi, Anthony. Thanks for joining us today.
Hi, Miranda. Thank you for the opportunity.
So today we're going to be talking about the indexation of the transfer balance cap that's going to be occurring from the middle of this year, subject to any potential policy changes we might see. So obviously we had the ABS figure come out at the end of January, which meant it was high enough to actually index by 200,000. This means we can now see personal transfer balance caps range anywhere from 1.6 million up to 1.9 million. Can you give us a brief outline about how that proportional indexation will work for each individual?
Sure. So the idea is that it limits an individual's access to the indexation base amount based on their previous highest value of their transfer balance account. So what we need to do is that we actually need to determine how much of their cap they have used to work out how much they have available still going forward. So we look at that highest ever value and we look at the earliest day that occurs, and then we divide that figure by their personal transfer balance cap on that day. And so legislation states that this is expressed as a percentage and it's always rounded down to the nearest whole number. And so once we've got that figure, we subtract that from 100% to work out what the unused proportion is. Right, so this percentage is then multiplied by the indexed amount. So come 1 July 2023, we're looking at multiplying it by $200,000. So to give you an example, might be an easier way to explain it. Let's say I've got a client who started a pension with $800,000 on July 1, 2017. Right, so we go through the process, we determine that they've used 50% of their cap of the $1.6 million that was available at that time. So they've got an unused proportion of 50%. So on 1 July 2021, when we first saw the first round of indexation, we multiply that 50% by 100,000, which would give them an increase in their cap of 50,000 up to $1.65 million. That would be their personal transfer balance cap. Assuming that there's been no change or no increase in the highest value of their transfer balance account come 1 July 2023, then they've still got a 50% unused amount. So we times that by the indexed factor coming up, which is $200,000, which would give them a $100,000 increase. So overall, on 1 July 2023, that person will have a personal transfer balance cap of $1,750,000, which is potentially going to be different to everybody else's based on what other people have had.
And that's the challenge, Anthony, that's going to arise here, isn't it? Is the fact that the first time we went through it, people were a bit wary because of, how does this work? But when you get it to index again and then potentially again, keeping track of this becomes critically important. And I know for some time there's always been the argument as to, the limitations of who can access this information online. But taking the actual calculation issue, though, it is going to become quite difficult and problematic because we're always going back and trying to find this smallest percentage of unused cap to work out that level of indexation.
Yeah, absolutely. And I think for people like you and I, Aaron, where we want to understand the calculations and we want to go through the process, this is what we enjoy doing. But for your everyday punter, you are relying on that information on MyGov. And as you said, it's not everybody has access to that. Financial advisors are the ones that are talking to their clients about starting pensions don't have access to that. Administrators are the ones that are setting up these pensions in the software don't necessarily have access to that. So it does become difficult. I think I went through a relatively simple example that no change, 50%, like it's easy to explain. But, if that same person started a pension with $300,000 on, say, 1 July 2022, then you're looking for a different figure. What is my smallest percentage? It was on a different day. what was my personal transfer balance cap on that day as well. So you really start moving away from the general transfer balance cap, and then every single client you're dealing with is a potentially different scenario.
Yeah. So the other one, of course, is for those that are entering the system, I guess, into retirement phase. So we're seeing this shift being a substantial increment, 200,000, as Miranda stated at the very beginning, from 1.7 to 1.9. So we would be seeing over the course of the next few months, people looking to start retirement phase income streams. And therefore, the natural question comes about, what are some of the considerations that you'd need to be contemplating as to whether you might start it now or you might start it, say, from 1 July?
Well, I think the obvious one that we'd go to first is having that, what value do I want to start a pension with? Like, if I want to maximise it, I can do it 1.7 now, or I can do it at $1.9 million in a couple of months' time. That's also, for me, it's a very short-term look on it. What's the difference over the next few months? But the other thing that we've talked about a lot over the years is the idea of what happens when I receive a death benefit pension and what that means for my transfer balance cap as well. So it's all well and good to say, okay, I'm going to lock in a pension of $1.7 million now, but if there's a chance I'm going to receive a death benefit at some point down the track, 5, 10, 20 years time, whatever it might be, then when I receive that pension, I'm still limited to that $1.7 million as well. So kicking the can down the road a little bit to wait for that $1.9 million gives me just a little bit more that I might be able to keep in the system when I get that death benefit pension. I guess the other thing to consider as well is that we always associate retirement phase pensions with exempt current pension income or ECPI. And so what does it mean from an ECPI point of view if I delay starting that pension? If I don't start a pension today, I potentially lose out on claiming ECPI for the rest of the financial year. Now, whether I go one way or the other is a bit of a numbers game, and it depends on what we're talking about. So if I've sold an asset, I've got a significant capital gain this financial year. Starting a pension now and getting some ECPI to reduce the tax that I pay on that capital gain might be a good opportunity now. If I don't do that and I pay tax on that, how many years is it going to take for me to effectively recoup that tax that I paid this year by getting the increase in the ECPI? Now, I'm not an actuary. I haven't gone through the figures, but it is a numbers game. But I guess what we're telling people is that but every client's going to be different. What's right for client A is not necessarily going to be right for client B. So the ECPI does come into it. I guess a couple of other smaller things as well. What is the purpose of starting the pension now? Are you starting it because you need access to that money? Can I take it as a lump sum? If you're driven by ECPI and you don't really want the money, if I start a pension today, I'm going to have to take a pro rata minimum pension out. Do I really want that? Do I really need that? Can I take it as a lump sum instead of a pension payment? So getting access to those benefits might sway you one way or the other. And in terms of getting access to that as well, it's the tax-free taxable components. You start a pension, you lock in your tax-free taxable component. So any allocation of earnings to that pension will now be based on the tax-free taxable components that you've determined at the commencement of that pension. So if I don't start a pension and I know I've got a large capital gain coming and the earnings from that is going to go to my accumulation account, it's all going to be a taxable component. Whereas if I started a pension, some of that earnings potentially becomes a tax-free component as well.
Yeah, and those recontribution, I was just going to say, those recontribution strategies are very common, obviously, in that planning process leading up into starting pensions. So, so you might be looking to execute a recontribution strategy now before you start an income stream, but the last thing you want then is to have that sitting there and being tainted with taxable component again because some of the planning has in essence been lost.
Yeah, correct. And so that's where it comes down to it. So 100% agree.
So now that we have the Awati figure as well, we have a bit more indication of what those bring forward thresholds will be as well. Can you give us a little bit of detail about how that will work now that we know what the contribution caps are for the next financial year as well?
So our non-concessional contributions and our bring forward thresholds are all linked to total super balance. But although there's not going to be any change to the contributions, there is a link between the general transfer balance cap and total super balance, which flows on to any potential strategies we might have with the bring forward rule. So at the extreme end, if your total super balance exceeds the general transfer balance cap, your non-concessional cap is zero. So if you contribute anything above that, you're going to get an excess determination. And so for the 22-23 financial year, we're looking at a cap of $1.7 million. So if I've got $1.8 million, there's a total super balance determined 30 June last year, I can't make a non-concessional contribution without having an excess. But that same $1.8 million, if that's my total super balance on 30th of June 2023, and the general transfer balance cap increases to $1.9 million, all of a sudden I'm below that cap and I've got this potential ability to make a non-concessional contribution. Right? So that's the biggest difference there, and that's where they really connect. At the other end of that scale, when we're looking at the 3-year bring forward rule, right? So when I'm looking at whether I can make a non-concessional contribution to trigger the 3-year bring forward rule, I've got to look at the general transfer balance cap, and I've got to subtract 2 years worth of the annual cap to get my lower figure. So what I mean by that is my general transfer balance cap currently is $1.7 million. Subtract from that 2 times the annual cap, which is currently 110, which gives me $1.48 million. So if I've got a total super balance of below $1.48 million, I potentially can trigger a 3-year bring forward rule. That same figure, that lower scale, will jump up to $1.68 million come 1 July 2023. And that's a significant jump and a big difference between being able to make a 3-year contribution or not being able to make a contribution at all. And I won't go into great detail, but we stepped down to a 2-year bring forward rule or just 1 year's worth of contributions in increments of $110,000, or the annual cap, I should say, because it's not always going to be $110,000 going forward. So, yeah, there is a link, and some people sort of don't always appreciate that link that's there.
And Anthony, just to touch on that a little bit further, because I think this is a common scenario that we see where people go, they're at this 1.7 at the moment, so they go, oh, well, I might have triggered a bring forward rule and all of a sudden, and 3 years, but all of a sudden I've now capped out because of the value of my superannuation interest. It doesn't mean that just because they've capped out in this year that they're lost, because there may be a scenario now where year 3 arises and that TSB is, the TSB is below what would be 1.9 being the general cap, which actually means that they can fall in again in that last year. So from an advisor point of view, understanding where someone is in their cap and to what extent they've triggered the bring forward rule, and then where these caps are moving, are all integral in the advice process.
Yeah, absolutely. And I think with that is that those thresholds that we talk about, you only really need to consider them in the year that you're triggering the bring forward rule, with the exception of the general transfer balance cap. So whether you're in year 2, year 3, if you're above that general transfer balance cap, your cap is 0. But other than that, it's only those thresholds you've got to worry about in the year that you trigger. So if I've triggered the bring forward rule in the 21-22 financial year, and at the end of that year, I found myself with $1.75 million, for example. So this financial year, being the 22-23 year, I can't make, so it's year 2 for me, but I can't make a contribution because I exceed that general transfer balance cap. Next year, year 3, I don't have to worry about the fact that I was out of the game for year 2. It's a new year. I'm still in my period, my 3rd year. If I'm below that general transfer balance cap of 1.9, I can then potentially go back and make that final contribution to get my 330 or whatever it was that I'm contributing. So,
yeah.
You've covered a lot of considerations for advisors and SMSF professionals already, but is there any other sort of types of strategies they should be thinking about ahead of the cap increase?
Yes. Well, that was one that I sort of had noted to talk about. So I guess the other one, if we're talking about the bring forward rule, is do we want to trigger the bring forward rule this financial year or not? If I've got $1.5 million, for example, I potentially could do 2 years worth of the bring forward rule this year. But if I delay that, and provided my total super balance remains below 1.6 at the end of the year, then next year I might have 3 years to do. Now, I'm not saying one is better than the other. A lot of the time, these strategies are long-term strategies. Maybe I only want 2 years. We missed out on the Waddy going up this year, but are we going to miss out again next year? I think the figure was high enough that over the next 12 months, we're going to be talking about the fact that we're probably going to get there next year. And so that will change all the thresholds again. And so maybe locking in a 2-year bring forward rule this year, just worrying about this year and next year, and then having free rein when the caps, assuming that the caps do go up again on 1 July 2024, might be a good strategy, right? Or maybe I don't want that. Maybe I'm happy just to do 1 year's worth this year and then trigger the 3 years being below $1.68 million. So once again, it's a horses for courses. It's not going to be the same for everybody, but thinking about that long term, whether we trigger the bring forward rule or not, it will come into consideration. I guess another strategy as well is the transition to retirement income streams, particularly ones not in retirement phase, or as some people say, in contribution phase or accumulation phase. So, I should say that to convert that TRIS to being one in retirement phase, I need particular events to occur. So attaining age 65, it automatically converts to being in retirement phase. Outside of that, we pretty much need to advise the trustees that we've met a condition of release. The main one will be retirement. But it doesn't happen automatically. It only occurs when you advise the trustee. So if I'm 62 years of age and I've just met a full condition of release, historically, I would want to rush out to tell the trustee because I want to get that ECPI straight away. I want the 10% maximum to disappear. I want the ability to take lump sum payments. But with the changes coming up, if I don't rush out to tell the trustee, if I don't tell them until, say, the 1st of July, then the earliest that pension will go to being in retirement phase and having an impact on my transfer balance cap is on the 1st of July. And so all of a sudden, I've now got access to that $1.9 million as opposed to the $1.7 million. But some of the things that we've already discussed around ECPI, being able to access that money and the like, is still going to come into play. Maybe I need more than 10%. Maybe I need to start a retirement phase pension now because I need more than 10%. Or maybe I want that ECPI. So once again, horses for courses. Do I tell the trustee that I've retired? And I know a lot of people will say, but you're one in the same person. Like, don't you know that you're retired? Well, yes, I do know that I've retired. But you've actually got to go through this process of telling yourself formally, I need to write to myself as the member to the trustee to say, hey, in case you didn't know, I've retired. And so without that letter, without that documentation, it hasn't happened. Right? So do you want the 1.9? Do you need it at 1.7? Right? So those sort of things are going to come into play as well. And there are some aspects around death benefits as well, but I think we might get into that a bit later.
Yeah, maybe let's have a crack at it now.
All right. So when we're looking at death benefits, let's look at somebody who may have passed away this financial year. So a husband and wife, let's say the husband's passed away on the 1st of March. If they've got an account-based pension, so let's give the husband an account-based pension of $1.9 million. Whether that pension is reversionary to the spouse or not will have a big impact on the transfer balance account for the spouse. So I guess the one thing to sort of highlight here as well, and we still get a lot of people not quite understanding this, is that the event itself is the pension commencing for the recipient. So if the husband died on the 1st of March with a reversionary pension, that pension reverts to the spouse on that day. That is the event, and that is the event that needs to be reported. We still get a lot of people saying, I've got 12 months before I need to report that. And that's not the case. You need to report the event based on the reporting obligations as they stand. Where they get it mixed up with is that, yes, the credit might not appear for 12 months, but you've got to report it straight away. Mm. Now, when that credit appears is where it really comes into its own. So the husband dies on the 1st of March, $1.9 million, reverts to the spouse. That credit to the spouse will not appear until 1 March 2024. Now, if that spouse has never had a retirement phase pension, has never used their transfer balance account, come 30th of June this year or 1 July this year, they're going to get the full indexation. So their transfer balance cap is going to be $1.9 million, which is going to allow them to keep that full death benefit pension in the super system if that's what they want. Now, as a side note as well, another thing where people get caught out is that pension has reverted to the spouse. It belongs to them. So come 30th of June, it is going to count towards their total super balance. And so although it's not counting towards your transfer balance cap, it is counting towards your total super balance. And so that might impact on any strategies that you might have in terms of contributions or the likes. You know that $1.9 million is going to be there. You know that that's going to be enough to push you over the general transfer balance cap. Your non-concessional cap next year is going to be zero. So maybe you want to get into those contributions this year. Where the pension is non-reversionary or we're dealing with an accumulation account, then the trustees will go through the normal process of dealing with that death benefit. What does the deed say? Do we have death benefit nominations on file? Who's in control? What decisions have been made? So for the sake of the argument, let's assume that the wife is going to receive that money and she's going to start a death benefit pension with it. The law says that you have to start a pension as soon as practicable, but the law doesn't tell us what as soon as practicable is. So the general consensus is that if you deal with it within 6 months, it's unlikely that you're going to be challenged on whether you've dealt with it as soon as practicable. So if we're looking at somebody who passed away on the 1st of March, it just so happens that 6 months spans 2 financial years and caps. So where a death benefit pension differs from a reversionary pension is that the reversionary pension, the balance of the credit is determined on the date of death. The credit appears 12 months later. With a death benefit pension, the balance is determined on the day that the pension is commenced and the credit appears on that day. So if the wife starts a pension before the 30th of June, then they're going to be measured against the cap as it is now, $1.7 million. So we know we're dealing with a balance of roughly $1.9 million. And so every likelihood is that some of that money is going to have to come out of the system. And just like the reversionary pension, that money is now an interest of the wife, which means that it's going to count towards her total super balance at 30th of June as well. Now, if the pension is not started until after 1 July, and Aaron, you would know this, so many pensions are started on the 1st of July.
Yep.
So it would not be out of the realms of possibility that pension is going to start on the 1st of July. Now, the big difference for that is that now we've got a higher cap. So we're now playing with that $1.9 million cap again. Now the balance will be determined on that day. So whether the wife needs to take some money out of the system or not will be based on what the value of the account is at that time. But the likelihood is, even if she does have to take some out, it's going to be a lot less than what she would if she starts the pension prior to that date. The other aspect is because she hasn't started the pension with it yet, it's not her money, it's not an interest of hers, so it will not count towards her total super balance either. Right? So that may free up some opportunities in terms of making contributions within the caps as well.
Yeah. So I was just going to say that. So I think what you've clearly highlighted today through this indexation process, and I think we've gone through this in one iteration a couple of years ago as well, is that it just opens up the opportunity to be going back and engaging with your clients on these things. We can dovetail this into the changes that we've seen with age, with contributions as well. So making sure as advisors we are keeping in very close contact with not only the client, but obviously the client's caps to ensure that we're maximising the opportunities that are available to them.
Yeah, I would agree. And as you pointed out earlier, every time we get indexation, it changes the conversation. It gets a little bit more difficult. And so, we're at the beginning of March now. We're only a few months away from the end of the financial year. This is not something you can leave until the last week of June and hope that it's all going to fall into place. It's something that you need to be thinking about now.
Yeah, absolutely. Well, thank you for your time. You're a wealth of knowledge as always. So we do appreciate it. And no doubt we'll be chatting to you at a podcast in the not too distant future. So thank you once again. No problem. Thank you very much for the opportunity. It was great to see you both. Cheers. Thank you.
Thank you.
So Miranda, as I said, when we finish with Anthony, then he is a wealth of knowledge in this space. And no doubt, I think many of our audience would have got some really insightful things that they could be going back to their clients with, not only from 1 July, but some decisions that they might need to do between now and then as well. So for you, what was the key takeaway that you got?
I thought it was good how he raised all those different factors that you do have to be thinking about when you're deciding do we delay the start of that first pension? It's not even just the ECPI versus having that extra balance in pension phase. It's also, as he said, the taxable component and balancing up all those factors as well.
Yeah, so, those little things that I guess he referenced can become very quickly some quite big things. So, he also spoke about the tris and the timing of the election, which you do have other than when you turn age 65. So, again, all of these are important decisions that you actually need to work through to decide whether that individual might take advantage of that, $200,000 increase that we've seen. And I think we will now see, I think I did hear in the last 24 hours or so, Jim Chalmers talk to the fact that they expect that to let it run its course. So we'll wait and see, and our fingers crossed, I think, most importantly. But as is always the way, Miranda, if people want to suggest any speakers, topics, how can they get in contact with us?
They could get in touch at editor@smsfadvisoronline.com.au.
Excellent. Well, thank you once again for joining us for this week's SMSF Advisor Show. Hope you've enjoyed, and we look forward to joining us for our episode in a fortnight's time. Take care and bye for now.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.
Imagine being rushed to hospital.
Yep.
And your life changing in an instant. Imagine going through hundreds of tests and 46 weeks of chemo. Now imagine you're a child. That's why Starlight exists, to bring happiness to seriously ill children. Please donate at starlight.org.au.